This is the second quarter 2011 Managers Report for the Prime London Capital Fund. My name is Stephen York and I'm the fund manager of the fund. This is a short summary of the full report, which is available in text form on the website. We're going to do two things: have a little look at how the fund has performed in the first 6 months, and then secondly, have a stab at forecasting what might happen in the second 6 months and thereafter. In the period January to June 2011, the fund's unit price rose 9% from 89.90p to 97.98p. The net asset value of the fund in the same period rose 10%. During the first 6 months of this year, prime residential property in London has developed a reputation as a safe haven from financial market volatility elsewhere in the world. That, together with very tight supply, has seen prices rise. It's also seen rents rise, and the underlying index of rents during the course of this 6-month period have risen about 2 or 3%. However, we have seen rents in the fund rise between 5 and 18% in the same period. The key decision for all investors into prime London property is whether or not this safe haven status is likely to remain, and of course whether or not one thinks that the financial market volatility is also going to become part and parcel of everyday life. In other words, as we said in our first quarter report at the beginning of this year, it is essential to have a view on the macro conditions that surround the investment into prime London property. In fact, to a greater extent than we have seen in the past, a clear view and understanding of these macro conditions is likely to be the determining factor in whether one is neutral, bullish or bearish on most asset prices, and that includes prime London property. So it is right that you should know the macro assumptions under which we, as the managers of this fund, are operating. Firstly, we believe that the turbulence in the Eurozone is likely to continue. However, we do not believe this will lead to a weakening of the euro currency against sterling. There are a number of reasons for this. Firstly, unlike the Bank of England and the US Federal Reserve, the European Central Bank has retained and will continue to retain its anti-inflation credibility. Secondly, as the US dollar continues to weaken against its basket, we think that the Chinese in particular, but other central banks, will diversify their currency reserves out of the dollar and will increase their weighting in euros. In short, if sterling remains flat to weak against the euro and against the Swiss over the next few months, this is likely to be a boost for prime London property prices. Secondly, we think the UK banking sector is likely to remain chronically weak for the foreseeable future. We also think that lending will remain weak. One of the principal reasons for this is that many of the UK commercial property loans which were made in the earlier part of in the period 2005 to 2007 remain underwater. Banks, having raised capital, have been able to forbear on these loans, but they still are undermining the balance sheets of the UK retail banking sector. And it is these bad loans that we think are principally responsible for the lack of lending into the UK economy. Thirdly, many of the UK banks have large UK commercial property loans on assets which are no longer worth the face value of the loan. Up until now, the banks have been able to avoid selling those assets, but having rebuilt their balance sheets, we think that selling will start over the next 6 to 12 months. This overhang of UK commercial property is likely to mean that any rise in underlying asset values in the commercial property sector will be subdued. But perhaps the most important part of our macro assumption is that inflation of 4+% is likely to become part of the architecture in the UK economy for the next few years. The whole of the developed world is looking to reduce its debt. It's not going to be able to pay down that debt unless it can generate GDP growth of 5% or above, which looks extremely unlikely. The only other way it therefore can be reduced is through inflation. And we think the Bank of England and the US Federal Reserve have in effect signalled to the markets that they are prepared to stomach, if not encourage, headline inflation of 4% and above. And why wouldn't they? 5% cumulative inflation over a 5-year period equates to a 30% real reduction in headline debt numbers. These macro assumptions lead us to certain key investment conclusions. Firstly, the volatility in equity and bond markets that have become part and parcel of the last few weeks will remain. News items as they cross the screens will drive equity prices up or down and yields up or down in quite dramatic ways. Secondly, we think that the UK interest rates will remain at emergency levels for the next year or so. But perhaps the most significant implication of our macro view is that real prime assets are likely to be favoured by investors over paper ones. One has already seen this, of course, in a dramatic way in the gold price, but other luxury items and other hard assets have also seen their prices rise as investors lose confidence in paper investments. Finally, to just pursue the idea of prime central London property as a safe haven, we undertook some research to see what relationship PCL had to the gold price. The conclusions were really quite remarkable. Over a 20 and 30-year period, the correlation between prime central London capital rises and the gold price is 60% and above. That is a much higher relationship than prime central London prices has to either equities or UK commercial property, and even, in many cases, to the UK housing market. But more significantly than that, since the financial crisis really started to take a grip, if one takes September 2008, when Lehman Brothers went bust, and then if one looks again at March 2009, which was perhaps the then bottom of the equity markets, the correlation in that period between 2008, 2009 and today has risen from its long-term average of 60% to nearly 90%. This doesn't necessarily prove that prime central London prices will continue to rise on the same gradient as the gold price. But it does show, we think, that over a long period of time, the two assets have been perceived as similar in the eyes of investors who want a safe haven. The dramatic move in the gold price over the last month or so may well, if these correlations continue, indicate that prime central London capital prices have much further to rise in this cycle. And this may well suggest that investors have historically looked at prime central London real assets and gold as similar safe haven assets at times of financial uncertainty and insecurity. Over the course of the next 6 months, the fund will be looking to lift its gearing from currently around 20% to closer to its long-term average of 35 to 40%. It will be looking to buy AAA residential stock in the key Knightsbridge, Belgravia and Chelsea areas, and looking in particular for those assets that A, we can improve, and B, once improved, can let and produce healthy cash returns for the fund and its investors. Feel free to call the fund and the fund management team at any time, and do look at our website where we post regular updates on our statistics and on the performance of the fund.